Hello and welcome to Small Business Speaks, the podcast where we get to know the people and ideas that bring businesses to life. I'm Jen Silverian, a recruiter and business owner that loves to shine the light on people that are exceptional at what they do. Today's guest is Marc Bautis, founder and owner of Bautis Financial in Montclair, New Jersey. Marc is a wealth manager, helping people achieve financial freedom and ensuring they never run out of money. He works with very sophisticated investors, many small business owners, as well as people like me that are, how should I put it, finance adverse. Because of his financial acumen, I've asked him to come on and interpret what's going on in the economy since COVID, since the news makes it sound like the end of the world. We're going to talk about different recovery scenarios, how to interpret unemployment numbers, and what to be doing about the things we can control. By the way, towards the end of this podcast, he has an inspiring message about 2 reasons we have to be hopeful. Make sure you stick around for that. Finally, Marc is a fellow podcaster. He's recorded 50 episodes of his Agent of Wealth podcast, and he's adept at breaking down complex issues. So I encourage you to check out his show too. You will even find an interview with me there as part of Marc's recent series on employment. I hope you enjoy this episode. Welcome, Marc.
Thanks, Jen. Appreciate you having me on.
I hope you brought your crystal ball.
I've been getting a lot of crystal ball questions lately, so
No doubt it's gotten a lot of use.
Yeah.
So, like everyone, I want to know when and how quickly things will get better. So, I have 4 main questions that I want to talk about, and I'll list them now, and then we'll go back and tackle them one at a time.
Sounds good.
Number 1, are we at the bottom or will it get worse? Number 2, can we anticipate a slow or quick recovery? 3, what's the impact of pumping all this stimulus money into the economy? And 4, what's your prognosis for the job market and unemployment rates?
Perfect.
So we're going to dive in. And you've promised to keep this pretty high level because we know that I am not an economist.
Will do.
So first off, are we at the bottom or will it get worse? And really, what I'm asking here is how can we interpret what's going on in the stock market, in consumer spending, in unemployment numbers, and are these even the most important indicators to be watching?
All right, so it's a good question. I think we've never seen anything like this, where we're coming into stock markets at highs in the beginning of the year, record growth, low unemployment, and all of a sudden it basically just stopped, right? The virus came to the US, cases increased, and we don't know what happened or what the impact is gonna be. But we do know that at some point there is going to be a bottom. There's going to be a recovery involved. And I think, a lot of it started with the first thing that happened was, even before the cases really accelerated here, was that the stock market did drop, right? So we had that historic drop basically over a 4-week period of time where the market dropped over 30%. And is the quickest decline in a month that we've ever had. And, at first people were asking me, well, what is going on? Is this ever going to end? Because day after day, you'd see these swings where it would drop 5%, 4%, 6%, 10%. And, no one really knew. When you see that happening in front of you, you don't know what, you just think this is never going to end. And there was that initial panic that set in. Then we saw that the virus came, cases really started growing. And what that happened was the economy then shut down. And now people are worried, all right, how am I going to pay my bills next month or next week? And, how does my family get by? And then now third, it's people are starting to look at the third phase of this of, all right, did we hit a bottom? We saw this record decline in March, but also we had basically a record bounce back in April. So we're not back to where we were previously a couple months ago, but we had 30% growth pickup in the stock market, and it's really trying to correlate those two, because at the same time that we're seeing this bounce back in the stock market, we're also every week getting reports on unemployment numbers, which are crossing these enormous, thresholds of, first it was 10 million, then 20 million. Now, last week we hit 30 million, and it's not slowing down. So on one side you see, oh yeah, the stock market is up, it's moving up. And on the other side, you see record unemployment, people are pulling back on their spending, consumer spending, and, we're just predicting more job losses, and it doesn't correlate. So that's the question, I'm getting a lot is, what is going on with everything? So I'll answer it by after that long intro to it.
No,
by
I
saying,
appreciate the talk about some of the indicators, because they do seem at odds with each other.
Yeah, and that's what it really comes down to, is that the stock market's it's a leading indicator. So just as we saw that it dropped before we saw the big unemployment numbers or the big virus case numbers, it's coming back up, because what it thinks that there's going to be a recovery pretty soon, and it thinks that there's going to be a boom after that recovery happens. And the stock market makes predictions just like you or I will make, or some economist that we see on CNBC will make a prediction. And the stock market is probably right more than you and I are, or some expert on CNBC. But that's what it is. It's a leading indicator. It knows that there's that all the earnings numbers that come out, or all the economic numbers, are going to be bad. But what it's saying is, in the future, in the near future, it thinks that it's gonna, it will pick up. There will be a hiring spree, and there will be a boom. Now, we don't know if that's going to happen, and there's obviously a lot of uncertainty and a lot of things that can go wrong, or a lot of paths that this recovery can take. But the stock market is definitely making a bet that we're going to bounce back, because it's 30% off its lows. And if you look back at it, and this was what was happening. I was getting a lot of questions of, this is crazy, I'm down. And I would point back to someone's, portfolio and say, we're only at October of last year, or we're only at, the beginning of 2019. So it's not like we have this historic collapse in the stock market. And I think, we can talk a little bit about some of the recoveries and the shapes of the recoveries. But the market is betting that, we're off a bottom, and that we're marching forward towards getting back to where we were.
Okay, that helps me understand how we're going to get into our next question, which is about the recovery and the speed and the shape of the recovery.
Okay.
So, one of the things that makes it so hard to predict is because we don't really have the certainty of an answer until we know that we can contain the virus without a second wave of infections and safely reopen the economy. If we knew there was an approved vaccine that would be available, in first quarter of next year, it'd be something that we could plan around. But this is the first time this has happened, and we don't know,
right,
how it's going to shake out. So as a result, as I was reading into this, it's typically three scenarios that are being discussed, like a, good, bad, and ugly. And those are a May reboot, a summertime V-shape, and a fall recovery. So obviously they go from, good to catastrophic. At this point, do we know that it's too late for a May reboot?
Yeah. So, a lot of this, obviously there's uncertainty. If I'm betting on a May reboot, I would say I would take the counter bet to that one. I think, just from what we're seeing with how these states are and everyone's opening up at a different pace. And just because, and you did mention in the previous question about, are these economic indicators the right indicators to be looking at? And the answer is no. It's really, everything's been driven by virus numbers. by new cases, new hospitalizations, new, death reports. That's what's driving the market, and it's also what's going to drive the recovery, which is based on how quickly we can get things back open again. And if you look at the trends, yeah, we're seeing some states open up quicker than others, but to have a May reboot is probably a little bit too optimistic. I know I'm in New Jersey. One of the things that happened this week was New Jersey was one of the last holdouts, but they said, all right, school's not open, not going to open back up again.
Oh, you did hear that? Okay.
Yeah, that was announced yesterday. That schools canceled until the fall. You're starting to see even colleges saying, we're not having anyone on campus for sports or for anything until the states open back up again, or till the fall. And I think on the business side of things, there's going to be same thing. There's going to be a transition in phases. Obviously, the less social interaction a business has, that probably the quicker that it's going to open back up again. But if you look at the hardest hit sectors or hardest hit industries, they've been decimated in some of the travel, the hospitality, the tourism, the restaurants. And, even if, everyone, it was announced tomorrow that everything's open back up again, I think there's still fear by the consumer that they're not going to go back to the way things were immediately. And, in some cases it may be never, but for some specific things. So that's why I think a May reboot is out. I think we're more likely to that summertime V-shape of the three is probably the most likely.
Okay, I was hoping you'd say that.
Yeah. Fall recovery, yeah, I mean, when no one wants to prolong, it's a delicate balance, right? We have to, what we don't want, and what probably the worst case scenario is, we open back up again and we all of a sudden see a new onslaught of cases, and we overwhelm our hospitals, and all of a sudden we got to shut back down to where we were. And, that's what we don't want. But then you're trying to balance that against every day that the economy's closed. It's hurting people, it's hurting businesses, and some businesses will never reopen based on, what's going on. So it's really a delicate balance. And then the other piece that makes it really challenging is we don't have instant feedback when, you can do things in phases, right? We can open up this part. I think, I'll use New Jersey as an example. This past weekend, they opened up the parks and the forests and opened those up to people to go into. And I think the theory is if everything was fine and, we don't see a lot of, cases come up, they're going to go to the next step and open up something else. Mm-hmm. The problem is the virus, the cases, they're a lagging indicator. So if there was a problem with the forests and the parks opening up, we're not going to know for 2 weeks.
It's true. And
that just prolongs everything and makes the opening up longer, which, yeah, I mean, optimistically, we want to say the V-shape in the summertime, but could it go into the fall? Sure. Yeah, it could. And that's the uncertainty of things.
Mm-hmm. So we've mentioned now this idea of a V-shape recovery. Can you tell us what that looks like, what that means, in the sort of alphabet soup of recovery shapes? There's a U, a V, an L, a W. What are the characteristics of a V shape?
Sure. And I don't know where but with all this talk, the shapes started gaining prominence and they're all over the place. A V shape is the most promising, the most optimistic. I think that's the one that everyone hopes we see. And what these shapes are trying to represent they're trying to represent the abrupt closing of the economy and how is the economy going to get back to where it was or back opened up. Mm-hmm. So a V shape is simply you look at the way a V is shaped, and we saw that abrupt closing, but we're also hoping for that really quick ramping up. As quick as everything was shut down, that's as quick as everything opens back up again. And if you listen to enough Trump press conferences, he promotes the V shape and reopening a lot. And like I said, it is the most optimistic. This is the one that everyone thought would, because you have this economy that's running at full steam, heading into the virus, it gets shut down. And the government really, with the stimulus package, they really tried to put together just a pause. Hopefully their theory on the stimulus was, we're going to just inject this enormous sum of money, give it to people, into the economy, to businesses, in the hopes that we can shut everything down. We can just almost have this pause, and all of a sudden, we get the virus under control, and it just explodes back upwards. Unfortunately, I don't think we're looking at a V-shape, or we may look at a form of a V-shape, but that typical, or that strategic one, real quick down, real quick up, it's probably not going to happen, just because of the fears or the emotional ties to the virus. And not everyone is going to just go back to where they were 2 months ago. I think we're seeing that certain things are going to open up and be like they were, but certain things are not, and are going to take time to get for people to get comfortable, which may even take until we see a vaccine or a treatment. So we may see on the pharmaceutical or drug side of things that we need to have before we get to that full back to where we were.
Yeah. It's true. It's very hard to unlearn that cautious behavior that we've all adopted over the past 6 weeks.
Yeah.
I hear gym owners around town, they've been given the go-ahead to open under strict guidelines, so very small class sizes and so forth. And still many of them, although they'd love to reopen, are reluctant to do it. Because they don't want to, create a second wave of infections.
Yeah, and that would lead to, we have a shape for everything. So that one would lead to like what's called a W shape. And the way a W shape is, same slant downward that we saw, we come out of it, and all of a sudden we have a second onslaught of the virus, and all of a sudden we go back into another recession. And the second recession would probably be harder to get out of than the first one, because there's going to be even more caution, because you don't want to see a third. You don't want to open back up again too quickly and see a third case of it. So the W is obviously more negative than the V shape. The one in between those is something called a U shape, where U shape it's where we're in this recession longer than we think, or longer than a V shape, where it's not an abrupt opening. So that's where you have the bottom of the U, where it's a little bit of time, but we do come out of it, quicker, or there isn't, a slant upward after the recovery happens. The one that's gaining the most prominence, I think, is what's called a swoosh shaped recovery. And if you think of the Nike swoosh, think of that shape, where we come down real quick, but then it's gradual, or it's followed by a gradual recovery as the lockdowns ease. People are cautious, and it's not a real immediate bounce back, but we do see it. We do eventually get back to where we are, even if it does take a little bit of time. And I think with the phases that came out of the government on the recovery and the opening up of businesses, I think that's probably the most realistic one that we're looking at.
Okay. So I was reading an economist that forecasted that we might be looking at a cyclical V followed by a structural L. Now, that was written in English, but it doesn't sound like English to me. Can you translate? Is that the swoosh that you're talking about?
So the swoosh is the cyclical V. So that's the first part of it. So that's actually not so bad. The second part, that structural L, that's something we don't want. What an L shape is, it's really this prolonged period of time where, like, economically nothing goes on. The model of this is Japan. So Japan had this, if you look in the 70s, the 80s, this high flying economy. And all of a sudden they hit a downturn and really haven't been able to get out of it since then. And their economy just plods along. It doesn't even really have, like our economy, where it's still cyclical, but it slopes upwards, over time, even though there is bear markets and there's recessions. You want to have your bottom be higher than your previous top. Whereas Japan, it's just stagnating. It's just moving sideways. And yeah, I mean, obviously any of these recovery shapes are possible, but that L shape is something that we do want to avoid.
Okay. So no W, no L.
Exactly. We want V's, we want swooshes. It isn't even an alphabet letter, but I guess that's how prominent Nike's been in our culture.
It sounds promising.
Yeah.
All right, let's move on to the consequences of pumping all this stimulus money into the economy.
Mm-hmm. So we've seen, and with the last stimulus package that was passed, I think we're up to $2.5 trillion. They're saying there may be even a fifth bill that's passed, which would probably get us over $3 trillion. It's an insane amount of money. And whenever you pump that much money into the economy, one of the things that people immediately think of is, are we going to see inflation? And what inflation is just, it costs more money to buy things. Think of like your supply and demand. If there's money trying to buy something, it's just going to raise the price of it. Mm-hmm. And the example I use is college tuition, right? So anyone can get a federal loan to help pay for college. So there's essentially an endless amount of money that people can use. So what do colleges do? They know if their tuition is $10,000 or if it's $50,000, if someone wants to go to school there, they can get a loan and they can pay $50,000. So what colleges have done over time is they've just kept raising prices up because they know the money was there for students to borrow and to use. Same concept here is now there's the economy has just been flooded with money. Mm-hmm. So we may see inflation down the road. We're not going to see it now. And it points back to something you mentioned earlier, is that consumer spending is down. I think it's like 8% or 9%
that's what
over the past month. And the reason is, no matter how much money people have or how much money the government gives them, there's certain things that we're not doing. I'm not going to book a trip or going to book a airfare or a cruise, even if you told me someone will pay for it. And it's just because that's we're in such a unprecedented time with the fear of getting sick of the virus. So people aren't spending as much. If that does change though, and if we do get that recovery and we do go back to normal, what we could see is that inflation piece coming up, which is not necessarily, it's not really good or bad. It just means that it could, it's something that we have to watch because things get more expensive and the consumer their spending patterns would have to change on it. And usually when inflation happens, it also is correlated with a rise in interest rates. Okay. And then you start bringing in things like that. How does that impact the housing market? Or how does it impact all these student loans or credit card debt or everything that has a variable interest rate? So yeah, it's definitely something that, we're in this big financial experiment, basically, when you just throw in, the government's basically said, we're going to support the economy and we're going to do whatever we have to do. So they've made interest rates are zero right now. Basically you can get, if you can get a loan, the interest rates on loans are very cheap. They flooded the market with money. But these things probably do have longer term consequences to them.
So inflation goes up, prices rise, and at the same time interest rates rise, meaning it becomes more expensive to borrow money.
To borrow, correct.
Okay.
Yeah, if you have a 30-year fixed loan on your house, not a big deal. But your credit card loans, your student loans, any lines of credit, they're all more or less likely to be variable rates, which means the rate is, if interest rates go up, usually the rates on those types of loans follow them up, and it just becomes more expensive. And then it now becomes a cash flow problem for everyone. Do they have enough money coming in to pay their normal typical expenses plus pay any debt that they might have, which is now increased? And that can become challenging for some people to do.
So now is the time to lock into lower interest rates if you can.
Yeah, I mean that's one of the things people will ask me, what should I be doing during this? And I'll say, one, look at your spending, look at your debt. the liability or the debt side of things, everyone has, we have control over. So that, look at that side of things. And then, I'll tell people, look at, if you want a home, look at whether refinancing makes sense. Interest rates have come down a lot recently over the past couple of months. And, whereas it may have not made sense to do last year or beginning of this year to refinance, it's one of the things that you can control. You can analyze and see whether it makes sense or doesn't make sense. And, that's one of the things that you can look at and have control over.
Mm-hmm. Good. All right. So we've talked about the stock market. We've talked about consumer spending. Let's talk about the job market and unemployment rates. And this is of particular interest to me because I have a recruiting firm and my business is predicated on companies being able to hire. So what's the future look like? Go back to the crystal ball.
Go back to crystal ball. Go back to that recovery shape, section that we talked about. Yeah, I mean, there's over 30 million unemployed right now. Now I know the number's doesn't tell the whole story because there's a lot of people that are, of the 30 million, that are furloughed, meaning that, it goes back to that, all right, we just kind of a pause in the economy and we're just going to pick back up where they were. And if that happens, maybe, half of those people really just start going back to work one day, just as they were previously. But we're still definitely at, our highest levels of unemployment ever. So there is definitely a change in the job market. It's really going to be predicated on what some of these industries that people are looking at as these are the hardest hit. These are the ones that, they're not going to open back up immediately, even if the economy takes place. So that's where I think it comes back to that. I think we're going to see a phased recovery on the unemployment side or on the employment side as well, where, there's going to be chunks. We get an unemployment number every week that they're called the jobless claims that gets published. Mm-hmm. And right now, over the past 4 weeks, they've just been steadily, each week it's a higher number than it was the previous week. And just like everyone was looking at the plateau of cases and hospitalizations on the virus, I think what we're looking to see is, can we see that same plateau on new people applying for unemployment claims? And I think we have to hit that. Once we hit that, we can say, we are on the ride to the recovery, because we've hit that plateau. Now we know, we just put 5 million jobs last week into the market, and another 4 million the next week. But I think that's one thing that I'm looking on my side is when do we hit that plateau to know that we are still a lot of people unemployed, but we're at least on the right path to getting people employed again.
Mm-hmm, mm-hmm. Yeah, and that's heavily predicated on how quickly we can reopen and what that reopening looks like, if it's a phased approach or not, because, ultimately companies have to feel like people are spending money again, and they can afford to expand and to hire back some of their furloughed people and to create new jobs.
Yeah, and if you go, it's going to bring it back to those numbers, those indicators that we were talking about with the virus. Everyone wants to point back to 2008, 2009, and look at that crisis back then. But that was before the economy could recover from that. There was a financial problem it was a financial crisis that had to be fixed. Mm-hmm. I think this is a little bit different, where we have to fix a pandemic is right. What has to be fixed. So, once the economy, once the market, once employers or corporations feel that, it's safe to open back up again, and it's safe to start hiring, and they feel comfortable that, things will get back to normal. That's when we're going to have that phased approach, or that rocky, I guess, path to getting fully employed again.
Okay. I'm about ready for some optimistic news, something to feel hopeful about. And right here, I'm going to steal a question from Guy Raz of the How I Built This podcast. Do you know that show?
I do. Big fan of that show.
Yeah, I thought you might be. So he started this series on resilience, and he was talking the other day to restaurateur Jose Andres. And in the interview, Guy asked, what are the reasons you have to be hopeful? So I'm going to put that question out to you.
Okay.
As a financial analyst, forecaster, economist, what are the reasons that we have to be hopeful about the future?
Okay. So I guess one thing I'll start off with. Warren Buffett, who's probably the most famous and successful investor ever, he had his annual conference in Omaha last weekend. It's an enormously popular conference. And previous years, people from all over the country he'd have it in an arena, and people from all over the country would come to the arena, and he'd riff on everything that he was thinking about. It was actually funny this year because he actually still had it in the arena, but it was just him on a stage in this enormous basketball arena. But one thing, and I listened to the conference, and one thing he said was never bet against America. And there are a couple things that I believe in, and America's one of them. We've gotten through every pandemic, every world war, every financial crisis, everything where as you're going through it, you're saying this time is different. We're not going to get through it. We're not. And what happens is every time America comes out on top. And I think that's one thing to be hopeful about, is that we've gotten through everything. And as unprecedented and as tough as this is, we will get through it. Mm-hmm. And the other thing that I bet on too is I bet on science. I think there's enormous amount of talent in our biotech, our pharmaceutical industries. They will come up with a vaccine. They will come up with a treatment for this virus. And I think that's going to be a lot of the precursor to for people to feel comfortable, people to feel hopeful, and people to feel safe. And we've seen it over the past month, where anytime there was positive news about a company doing great work on a vaccine, or this treatment working to reduce the impact of the virus, it was uplifting, and the market even was uplifting about it. So those are my two things. I think I'm betting on this country and betting on science to get us through it.
Oh, thanks for that. That was very well put. All right, I have really two final questions
Sure.
for you. So first of all, speaking about optimistic outlooks, the news makes this sound like the end of the world. And it's particularly bad, I think, because it's an election year. So everything has this overlay of a political agenda attached to it. I'm curious what news sources you rely on for unbiased, factual reporting.
Sure. Yeah. I mean, like you said, it's if you just listen to the news, you'll want to crawl in a shell and stay there for years and never come out. You take that on top of everything is so politically driven, where it's, you take one story, you listen on one station and it's painted one way, and you listen on the other station and it's painted on a completely different way. And it's tough. And I do, I'm guilty of it too, listening on, I'll try and listen on both sides of it just to see kind of how they're painting the story. But you want factual, you want to listen to facts, or you want to read facts and try and make your own inferences from them. So, I mean, there are certain things I listen to, and some people will say, yeah, that one's on this side of the politics, spectrum, and on the other. But I'll read the Wall Street Journal every day. I'll read Barron's every day. I'll read The Economist, Financial Times. I'm a fan of Twitter, and not that I'm tweeting all day, but I can at least pick and choose what people I want to follow, what people are producing content, whether it's some videos, blogs that I look up to and say, yeah, this is a unbiased opinion. They're dissecting facts, and I can really be selective about who I follow on there. And like I said, it's all getting. You want to get through the hysteria. Look at the facts of things. I had one person who who I had talked to, and their philosophy was stay off of Google. because, and it was in the medical field actually, where, your arm hurts, all of a sudden you start searching it on Google, and, you come up with 45 different afflictions that it could be. Same concept with this is, everyone's researching, and it's just a lot of negativity of, yeah, this is the worst thing ever, and we're never going to get back, and, this time is different. And, like I said, it's good to have the knowledge. It's good to have the facts, but you just have to weed through the hysteria to get there.
It's true. It's true. I like Twitter too. And I know you're a fan of Tim Ferriss, as am I. Do you follow his curated COVID Twitter feed?
Yeah, he's got some good stuff on there too. And, I mean, some of his, you were mentioning the how he built this, but like his tribe of mentors and some of his other stuff, it's great. Not just with the COVID facts, but also he's a great interviewer. He gets a lot out of everyone he interviews. So, that's one of the reasons I like him as well.
Yeah. Okay. So I want to go to what you said in a recent blog post, because you were talking earlier about, some of the things that you can control in this scenario. You said, stop watching what others are doing. Focus on your own needs, portfolio, and risk tolerance. Don't try to time the market, define your strategy, and stick to it. So obviously this is affecting everyone differently, right? There are people that are still employed and have money in the bank and are wondering, what they should be doing with that. And there are others that, maybe have been laid off and need to conserve right now. So if someone is interested in working with you on a personalized strategy, where should they find you?
Yeah, best place is if you go to my website, which is bautisfinancial.com. So that's BAUTIS financial.com. I have a link there where you can schedule a free consultation with me. I'd be happy to, talk about any specific financial questions that someone has. I mean, you mentioned it. It's really about focusing on what you can control. There's a lot of stuff we can't control, but there's even more that you can control. And that's what we should be focusing on. And like you said, also, everyone is different. So what a strategy for one person may be the completely opposite of what someone else should be doing. And it's important that you have your own strategy and not something you just listen to off of CNBC or, you heard on the evening news. Really, you want to make sure you're making the right financial decisions with your money.
Mm-hmm. Well, thank you so much, Mark. My husband and I have really enjoyed working with you on our own financial goals and investment strategy. And I encourage people to check you out because, as we've seen in this podcast, you have a knack for breaking down very complex issues and making them approachable for the rest of us.
Thanks, Jen. Really appreciate you having me on.
Hi, guys. It's Jen again. I hope you enjoyed this episode of Small Business Speaks. We're releasing new episodes every week, so take a minute now to subscribe and rate us in Apple Podcasts. And if you have a favorite small business owner you'd like us to feature, leave me a message in the show comments or at Small Business Speaks on LinkedIn, Facebook, or Instagram. Thanks for listening.